All right, let's talk about your money with my good friend Nick Hopwood, founder of Peak Wealth Management, managing $300 million for small business owners and high net worth individuals for the last quarter century. His team helping people get their peak confidence when they retire. That's right. Nick Hopwood, welcome back to the program.
Thank you for having me, Steve.
And I couldn't ask you this in the break because I didn't know the answer. I didn't want to blow the spontaneity of it all, but new clients last week because there was an annuity disaster situation. I don't know what that means. An annuity disaster, please tell me.
Well, I think we can call this a public service announcement. Not all annuities are bad, but some are terrible. So we have some people come to us from another advisor across the street who put them in 10-year annuities with 12% surrender charges. And to boot, the annuity's been around for a few years now, and they put $100,000 in, and their cash value is only $75,000. While the market's stepping higher, this annuity is somehow losing value.
I thought, well, I don't have an annuity, so educate me here a little bit. I thought basically it was an insurance policy so you didn't lose money. That was my understanding. Did I miss a chapter somewhere?
Well, there's so many different flavors out there. There are annuities where the money's perfectly safe, like a fixed annuity. There are others where you can lose money, like a variable annuity. And then there are others that are built for lifetime income, where the market value can fluctuate up and down, but your income is guaranteed for life. So it just depends on which one that you're interested in. But always, always, you want to ask, how long am I committed to this product? Is this, a 10-year or a lifetime commitment? You should know those things before getting married to it.
Yeah. I would say that's a disaster. If you buy into an annuity, think you're going to have this, return, and then it's not there, I would call that a disaster. I think that's there. So what's your solution?
Well, what we're doing is building this retirement analysis for this couple, and we're going to figure out, are these income guarantees worth keeping, or does the plan work better off if they just take the hit and move on?
Right, take a brokerage account, which is what you tend to focus on, tax advantage accounts, and make sure the people are making a plan and having a strategy, if you will, right? That's what you put together for people to be able to retire, to manage the money, to know what they have, and to be able to forecast. And a moment ago, you did tell me that forecasting into 26 is frightening for people because their taxes go way up because Trump's tax cuts are going away by then, right?
Yeah, we do financial planning for all clients. So we're projecting cash flow into the future. And it's interesting because right now you see, the estimated income tax for 24, 25, and then it jumps way up in 26 and beyond. And clients look at that line and they say, why are my taxes going up so much from 25 to 26? And it's just like you said, the Trump tax cuts are going away, and it's a real deal for people.
And here's something else that you and I have talked about, is the stress test. Kind of look at what happens if all of a sudden your returns, not as bad as the poor folks in the annuity, but if your returns get smaller, right, and you're not getting, 7 or 8 or 9%, and all of a sudden you're at 1 or 2 or 3, can you take it? What would it look like? You put people through these scenarios, don't you?
Yeah, when we do our forward projected looking retirement analysis, we like to use a 5% forward looking return, as you say, to stress test the plan to make sure that even if returns are below average for an extended period of time, that we're going to be okay. And so then we also run what we call a Monte Carlo analysis, where we run the average return of 5% 1,000 different times, because the order of returns matter. So there could be a situation where you make 5% and you're good. There could be other situations where you make 5% but you're not okay, and that's because of the order of returns. Steve, here's an example. Imagine if you retired in 1991 and you had 10 years of fantastic returns in retirement to begin. You'd be in pretty good shape. Now imagine if you retired in 2000. You had 10 years of zero return, because remember, we had that lost decade for the S&P.
Sure.
There's tremendously different outcomes, even though it's just luck. When do you retire? You can't control that.
Yeah. Here's something else that we talk about from time to time, you and I do. And because I don't know what Jerome Powell is going to do, I don't know what the practical application of what he does is on me, but again, they did not touch interest rates. They remained high at the Fed. Inflation remains at what, 3.3, 3.4%? Actually, that's kind of, not really honest, but it's what they're reporting. Nowhere near the 2% is the takeaway. So now they're saying maybe one rate cut between now and the end of the year. And to me, it would still seem to be a very political move, because if you're not at 2%, why would you cut the rate unless you want to impact the political season? Your thoughts?
Well, I think you could be right there, and this is just their best guess. They call it the dot plot. We've been talking about this for over a year now, about when is the first rate cut going to come, and it just keeps getting extended and extended. And like you say, inflation has been stubbornly high, so it wouldn't surprise me if these rates are unchanged for the rest of the year. Let me talk to you about the money markets right now, because this is one of the silver linings of having the Fed rates this high are the ability to earn on the money market. And so consider this: when you invest in the money market, you're paying income tax on the earnings, right? Well, that's federal and state income tax. But if you had purchased a treasury bill, which is what makes up the money market, okay, buy the treasury bill outright, now you avoid state income tax. So I think that's an interesting thing, for people in Michigan and Ohio who are paying,
right,
or New York or California who are paying higher state income taxes than others.
All right, so there it is, folks. There's Nick Hopwood kind of sorting out your money, what's left of it after the inflation rips through some of it. Anyhow, we have a QR code for those of you that are watching on television. Click on that. You can go straight to nickpeakwm.com. Peak Wealth Management, the place to find out more with Nick Hopwood. Nick, always a voice of reason in a storm of insanity out there. Thank you for what you do. Thank you.
My pleasure. Thank you, Steve.
Greatly appreciate it. There it is. Man, careful of those annuities. Wow. What a story. I'll be right back on the Steve Gruber Show.